My contact details are never because first time I'm joining.
The question will be on the screen as well. So
Okay.
you can follow on the screen as well. And then I'll add you after class and we can you will have the question and the solution as well.
Okay, where do I give my cell phone number?
We will share the number on the screen now.
Okay.
When the session starts. If you can just give another, say 5 minutes, and then we will join. In the meantime, if I can ask everyone to please post their student numbers in the chat section, I would highly appreciate that. That is our form of attendance. Good afternoon, everyone. Please note the class will start within a minute. Please remember to post your student numbers in the chat section. I did WhatsApp the question that we will be doing. For those that are not on the WhatsApp group, the question will be on the screen, so you will be able to go through the question as we do it. Okay, good afternoon, everyone. Thanks for joining. If I can ask you guys a favor to just make sure that your mics are muted. Some of the noises make an echo of my own voice. And it's not so nice to listen to my own voice the whole time in echo. We have gotten to the end of the semester with MAC3702, this being the last session for this class. Consultations are still open, but as you know, the exam is literally a few days away and time is limited. So we will continue to assist where we can. As you know, this is not the FACET class. This is not a lecture. This is literally me going through some of the questions with you and giving you exam advice and to ensure that you have mastered the necessary skill to obtain the maximum number of marks or not to lose out on the more easier marks that there are in the question to get. And those easy marks are the marks that we sometimes forget about because we keep on focusing on the more difficult calculations or what we perceive as more difficult, and then we miss those important easy marks. And that is, in most cases, the difference between a pass and a fail. Let's quickly go over the session notes or pre-session notes. So that's the WhatsApp number that I've been talking about. It's a 063-297-9113. That's the voluntary WhatsApp group that I've been running over the past semester. So if you want, you can send me your details to that number and I'll add you to the WhatsApp group. Although the exam is a few days away, I might share additional questions and stuff over that over WhatsApp. And there's questions that we might not be doing in the session, but I will share it nonetheless. And then also the sessions that we are doing, questions that we are doing in the session, I will then also add on that group, as well as the solutions or my explanation of the question. And then finally, this is going to be quite a long session. Well, it's scheduled for 2 hours. It might run more than that, depending on the participation. But to focus on, or to put emphasis on that, the latter part of what I've just said, it is a participatory session. This is not the FACET class or the lecture class where you just listen and take in what is being presented. This is a participation where you get to do the question real time with me here, and where you can ask questions that you might be unsure about. So the first question that we will be doing is weighted average cost of capital question that I've just shared. We're going to go through that, and I'm going to show you how you should attempt that question, because that's in most cases the biggest problem is that question lands in front of you and you are not entirely sure on how to start that specific question. So it's very important that you pay attention more to that in this session, is on how to do it. And then obviously I will provide explanations, and then also that WhatsApp number where you can continue to ask questions. And then point number 6 is the one-on-one consultations that I've been referring to. That is available through myself. That's available to all students registered for this module in the Western Cape Province area, because that's where I'm the facilitator. So if you want to use me to assist on one-on-one consultations, you must be registered in the Western Cape province. Otherwise, I won't be able to assist other than this setting where we are in now. Then please remember to post your student number in the chat section, since this is our form of attendance. Okay, so before I start, I see there's some questions, and if there's any other questions before we start, you guys, please feel free to ask. But Crystal, I see your hand is up. Crystal, you can just unmute. Sorry, Crystal, can I assume you have no question? Okay, guys, I'm going to put up the first question for today. I'm going to scroll right through to the required section first. That is what I want you to do in the exam, or that's my preferred way of doing it. Let's rather say it like that, each to its own. It's important that you know what they want before you go through all the information, because if you don't know what they want, you will have to go through the information twice, and that's a wasting of time. Read what they want, understand what the question is all about, then you put your mind in the position, in the space of taking in that the information in a whole different way, to pay attention to areas that you might not have focused on when you read through it the first time. So first, understand what it is that they're going to ask, what the question is all about. So the first part, if I read required A, is calculate the weighted average cost of capital based on the current capital structure for 20x14 by making use of the market values. Make use of your financial calculator where applicable, and include the steps on the financial calculator in your answer sheet. So why is it important to read the required? Is you need to know what they want, for when they want it, and how they want it. So there they are very specific in what they want. And if you don't pay attention to any of that, it's very important to know that you're going to be missing out on some of it. Guys, I've shared the screen. You should be able to see the screen now. So required part A, calculate the weighted average cost of capital based on the current capital structure for the 2014 year by making use of market values. Then they go further and they are very specific. They say you can use your financial calculator, but you must include the steps that you take when you use the financial calculator. In other words, they want to know, how did you use your calculator for them to be able to identify, did you master the skill in using that that way of calculating. Then they ask you to briefly explain how the issuing cost will impact the cost of equity of the new shares. So highlight that for the new shares. Calculate the number of ordinary shares which must be issued in order to finance the expansion. And then D, list 2 assumptions behind the use of a firm's current weighted average cost of capital as the discount rate in an investment appraisal. Any questions so far before we read the information? So by now, before you even read the information, you know that you've already have an idea of what your probable approach will be. You have to determine, guys, just make sure that your mics are muted, please. So firstly, you have to determine what the current capital structure is, because they said you want to calculate the weighted average cost of capital based on the current structure. And then they go further. They ask you a bit of a theory question or an application question. You have to explain how the issuing cost will impact the cost of equity of new shares, and then you immediately realize in C there's an expansion that you need to pay attention to. So there will probably be an expansion that you will have to finance through either shares or through either through equity or debt, and maintain the current structure. And then D again is a theory question. Let's do assumptions behind the use of the firm's current weighted average cost of capital as the discount rate in an investment appraisal. So let's quickly have a look at that. Let's read the information. Okay, so Hotel 365 Limited is a hotel group that operates in the Western Cape. The following is an extract of the Statement of Financial Position for 30 June 2014. Dates, very important. They give us the equity and liability section. There we have the total equity. We have the total liabilities, current liabilities. In other words, immediately without reading any other information, they're already putting you kind of in a position to be able to determine the current capital structure. What is the total portion of your capital structure that's attributable to equity and to liabilities? But they give you the various items under each, and it's important for you to realize which of these to include in your capital structure. So that's what they're going to test. Then they say notes. Now they're giving more information on the various items that's listed. The number of issued shares has remained unchanged since the incorporation of the company. The first dividend were declared on the 1st of July 24 and amounted to R12.50 per share. Important. Since the first year of declaration, the dividends increased at a constant growth, highlight constant. It's an indication of what you can use, what method you can use to calculate the cost. You know the dividends, the growth model, very important. A constant growth rate, and management expects that the growth rate will continue. So consistent growth and will continue, very important. Dividends declared on ordinary shares for 2014 was R25 per share. The payment of the dividends are, however, still outstanding. You need to determine what the impact will be on that. Does it affect the growth? You still have the dividend, so you need to determine what the effect will be. Ordinary shares currently trade at a market value of R225 cum div per share. Can anyone explain to me what cum div means?
Is that not the shares with the dividend accumulated?
%. It says cum dividend, which means with dividend. So when a company has declared that there will be a dividend in the future but has not yet paid it out, you say cum div. So a stock will trade cum dividend until the X dividend date. After that, the stock trades with its dividend. So that's currently the price per share with the dividend. So it's important that you understand what that means. So the actual price per share is R200 because we haven't paid the R25 dividend yet. So it is still including dividend. Preference shares. The non-redeemable preference shares has no conversion right. What is non-redeemable? What is the effect of non-redeemable on this whole scenario? The moment that it is redeemable preference shares, it means, or if it's compulsory redeemable preference shares, it means that those preference shares are in fact in nature not equity. It's debt. Because you will be required to purchase those shares back from the preference shareholders. In other words, give them their money back and taking the shares back. So it's almost in nature the same as a debenture. If it was a compulsory redeemable preference share. So always be on the lookout for that you don't mistakenly add such a preference share to equity instead of debt. But in this case, it is non-redeemable preference shares and have no conversion rights and carry out a dividend payout ratio of 12% per annum. Excuse me. Similar preference shares have a current market return of 10% per annum. What did the required section say? We have to use market values. A flag must go up there. Point number 3, debentures. Debentures mature in 8 years' time at a discount of 2%. The debentures carry an interest rate of 15% before tax. So you still have to multiply it with 1 minus the tax percentage per annum. The prime interest rate has decreased since, and similar debentures are currently trading at R12.50 before tax. Market values, another flag. Trade and other payables. Trade creditors are paid within the credit period without any interest charged or discount received. The long-term financing structure does not include any credit financing that relates to working capital. Bank overdraft. The bank overdraft rate is 20% per annum, and it forms part of the normal working capital funding. And here we get to the expansion part. So all the information that we've just read is information that should put you in a position to calculate the company's current capital structure. Because the question says we first want to calculate the current capital structure, and then we're going to look at the expansion. So 20x15 expansion strategy. The strategy for 2015 is to expand the current service offerings to the Eastern Cape area. This expansion will amount to 540 million. So that is what will need to be funded. We will have to determine what the weight will be. So then they say the project will be financed in the ratio of 60% equity and 40% debt. Remember one of the required sections? You see how it's important to read the required section? There, the required section said how many ordinary shares would have to be issued when we look at the expansion strategy or the expansion project. 124 million of the retained earnings are available for funding of the expansion. The new ordinary shares will be issued at the current market value. Issue cost of 8% will apply. So 124 will be taken from retained earnings. So you must determine what is the amount that will actually be funded through equity and debt by taking into account what will be funded through retained earnings. And then some other information is the current tax rate is 28%, and you may ignore dividend tax. Cost of capital is calculated based on the market values. So the first part is calculate the weighted average cost of capital based on the current capital structure for 2014 by making use of the market values. Make use of your financial calculator where applicable and include the steps on the financial calculator. Okay, so as I said, this is for participatory class. So what I would like everyone to do, I'm going to try and make the screen a bit smaller so that you guys can see. For those who do not have the question, can ask me to scroll up and down. What I would like you to do is first list for me the items that will form part of the current capital structure. So don't calculate anything yet, just determine or list what your capital structure will look like. In other words, what will be the main items in your capital structure? And then we will tackle each one of them separately and also in a participatory manner. So first start your capital structure by identifying those items. I'm going to give you about, say, 2 to 3 minutes. If you are done, please use the hand functionality. That will give me an indication of who is done and who's not. If you want me to scroll up and down, you can just unmute and ask, and I will just scroll to where you guys want. So if you are done, you can just put up your hand. So I just want to make sure the guys whose hand is up at the moment, I assume that you are done. Otherwise, you can just unmute and ask a question.
Yes, so must we calculate the cost of capital or just list the items because I've listed it already?
100%. Okay. I'm going to give another minute or two and then I'll continue. Okay, guys, let's have a look. So let's look at the ordinary shares. So ordinary shares will be the first item on the list. We will have the preference shares, and we will also have debentures. So let's list the market value of these instruments. I'm going to give you another 2 minutes to please list for me the market value of these instruments. 1 minute, 2 minutes.
Sorry, can you scroll up? I can't see what the value of the ordinary share is. Thank you.
Can I continue? Would you guys like another minute or two? Well, let me ask, is there anyone that wants another minute? Okay, I take the silence as...
Sorry, sir.
Yes, Indisiwe.
Yes, I will only calculate the market value on ordinary shares or on
All of them. Ordinary shares,
all of them.
preference shares, yes.
Oh, can I see note number 2, please?
Okay, I'll give another minute. Remember, guys, participation in this specific session is very important because you highlight areas that you might need more understanding on. So it's important to participate because then you actually put yourself on that path of identifying what it is you might be struggling with and whatnot.
ezokwazi ungena because ifoni le lapha kuthi sinayo gold.
Can you go back to the balance sheet again? Sorry. Thank you.
Guys, let's take a pause there quickly and let's look at the valuation of ordinary shares. Then we can continue with the rest of them. Okay, so let's look at the calculations. So to get the market value of the ordinary share, ordinary shares, you will have to take the number of shares times the market value. Okay, so what is the current market value? Or what's the number of shares? There's 20 million. They give it to us there in the total equity. They say there's 20 million issued. If we go to the information, they say the ordinary shares currently trade at a market value of 225 Rand cum div.
So you must take out the cumulative part.
100%, because that's not really part of the market value for these purposes. So times 225 less 25, and that will equal 400 or quite a massive amount, 4 billion, if I'm not mistaken. Everybody happy with that?
I've got 4.5, Charles. Charles?
Yes. For Lisa?
I've got 4.5.
Yes, it's because you multiplied with the 225. You must multiply with the 225 less the 225.
25%.
No,
What?
Rand. Can you see the screen?
Yes. I've got you now.
Okay, you have to take out the dividend part.
Oh,
So
okay.
remove the dividend part of the share price, the market value. Everybody happy with that?
Yes.
Okay.
I will include this in the answer that I will be forwarding to you guys.
Okay.
Okay, so let's put that in. So it's 400 or 4,000. That's quite a massive amount. Okay. And that's how we got that. Okay, so let's look at preference shares. Preference shares, 5 million issued. Okay. They say here on the preference shares, it's non-redeemable preference shares. A dividend payout ratio of 12% per annum. And then they say similar preference shares have a current market return of 10% per annum. So how do we get that market value? Let's go to the preference shares. So you have to say the market value equals the dividend over cost of equity. And that equals, what is the dividend? The dividend is that value, the 1.25, 1.250. Sorry guys, I only recognize now you guys can see the calculations that I'm busy with. Apologies. So market value equals the dividend over the cost of equity, which then obviously says it's the 1250 times the 12%. And that over cost of equity. Cost of equity at market value is what similar preference shares are trading at. The current market return of 10%. So divided by 10%. What does that give me?
So I get confused of when to deduct tax and when not to deduct tax.
Sorry, just repeat.
I get confused when you need to deduct the tax and when not. Is it just in cost of capital you must deduct the tax?
Okay, so I'm going to explain it in a very practical, just a practical way, so you don't forget it. Because I don't want, because remember, guys, when you prepare another exam, I'm actually glad you asked that question. When you prepare for the exam, the moment that you need to start remembering formulas, you are going about it the wrong way, or remembering something, you are going about it the wrong way. Ask yourself why. I think it was Crystal that asked why now. I didn't see the screen. That's important. You need to ask why do we do it, so that you can remember it in the exam in a practical way. So remember, tax is allowed. You can deduct the tax on interest expenses. In other words, tax goes to SARS. So something that doesn't come to the entity, or something that is not required to be paid by the entity, shouldn't be included in my decision-making calculations. That 28% goes to, or whatever the tax rate is relevant, is relating to a claim to or from SARS. Okay, it doesn't affect my decision-making. Tax is not applicable on equity. So any form of equity is not applicable, and since this is non-redeemable preference shares, it is equity in nature. So tax is not applicable at this stage. Does that make sense for everybody? The explanation. Crystal?
Yes, thank you.
100%. So if I calculate that correctly, it is 150 million over the 10%, and that equals, if I do that divide, it is obviously 1500 million.
Charles, can I please ask something?
Yes.
On the financial statement that we were presented with, why is the preference shares listed under non-current liabilities?
Just quickly have a look. I wonder if that's not I must double check that. I think that's not right to start with, because it is equity, it is non-redeemable preference shares. And it's only when it's compulsory redeemable preference shares, that it must be listed under equity. And even if you calculate it, tax is not involved in this case. So I therefore do not see why it should be listed under current liabilities. Please send me a WhatsApp on that. I will follow it up with a lecture. I feel that that might be a mistake.
Okay, thank you.
Well spotted. Any other questions on that?
Hi, Charles.
Babawa.
Can I add? I might be wrong, ne? She just asked a question about preference shares.
Yes.
Isn't it because on note number 2, they've stated that non-redeemable preference shares have no conversion, because normally what they say, if you stated the non-redeemable preference shares with conversion, then you treat them as equity, not debt.
So,
Correct.
So are you saying if had they mentioned something different on the notes, then
On
we
the
would
notes.
treat them differently? Is that what you
Yes,
said?
I
Okay,
think so.
madam. Okay.
Yeah, I've just confirmed on this side as well that currently I do not believe that it should be listed under non-current liabilities, since they say it is non-redeemable preference shares. Because the moment that it's redeemable, it means you'll have to be able to whenever the shareholder asks for apparently I was muted there by someone. Please, guys, whoever did that, refrain from doing so. If you want to, if you have a redeemable preference share, you give the right to that shareholder to ask for, in layman's terms, his money back in return for his share. That means that share can be redeemed. But since it's non-redeemable, it means that you don't give the shareholder, you issue those shares to the shareholder without that right. And only redeemable preference shares are treated like loans and are included as non-current liabilities in the statement of financial position. Everybody happy?
Hi, Charles, can you hear me?
Hi, Leratu.
Just to make sure that I understand, when I went through the notes for financial instruments, it was stated that the non-redeemable preference shares are equity, like you have said,
Yes.
and then the redeemable preference shares are liabilities.
Correct.
And that will fall under your non-current.
Correct.
Okay, thank you.
Okay, so please just make a note on the question. It might actually have been there to confuse you. So the information might actually have been there, but for you to apply it correctly. The company might have listed it as non-current liabilities. However, when you calculate your weighted average cost of capital, you should have known based on your principles from this module that a non-redeemable preference share is equity in nature and not a long-term loan. So I do not want to dish the question and say that the question is wrong. They might have done that deliberately so that you can realize that, wait a minute, you have to treat this different. So very important point coming across here. As I said when I went through the question for the first time, when you look at preference shares, it can go either way. It can be debt and it can be considered equity, but the information will guide you. So if it is redeemable preference shares, and specifically compulsory redeemable preference shares, then we get to a point where it is a loan. If the questions say that redeemable preference shares is redeemable within 12 months, then obviously it will move from non-current to current liabilities. So be very careful there on how you read it. Think about what is the definition of a loan. What is the definition of a loan? Loan is debt. Debt is a liability. So the definition of a liability is the obligation due to something that you did in the past that will lead to the outflow of economic benefits. If you still remember your definition of liabilities from accounting, you have an obligation. So if something is non-redeemable, is there an obligation? to pay them their money back that they've paid for the preference shares. There's no obligation. So the moment that that obligation element is absent, then you treat it like equity, which is in this case.
Market value.
Elewa?
Oh, sorry, sir. I must mute myself.
Thank you. Okay, so let's quickly go back to the calculation and add that. If you guys have got any questions, please don't hesitate to ask. So 1.5 debentures. I want to quicken the pace a little bit because I want to go through another question with you guys today, if possible. So see if you guys can please calculate for me the debentures. So I'm first putting up the balance sheet. If you guys want the information on the balance sheet, that's a balance sheet value is 850. And then I'm going to go to the note. So everybody's got that value. The debentures on liabilities is 850. And then please go to note 3. I'm going to give you another 3 minutes to calculate that for me. And when you're done, please raise your hand. And it's just an indication for me that to see how many people have completed the question. Guys, just a note there. If you've got a question, please just unmute and ask the question. I don't always look at the notes. There's too many questions and student numbers coming through in the chat section. So don't be scared to unmute. You can just unmute and ask the question. I would appreciate that.
Can you please go back to the instruction?
Just another reminder to please post your student number in the chat section. And when you are done, to raise your hand just as an indication for me that of who has done and who not. Crystal, you are muted on my side. I think that's why no one can hear you. Okay, guys, let's have a look. So they tell us what the the value is. They say 815, so that's obviously one of the starting points. Let's read the information. They say debentures will mature in 8 years' time at a discount of 2%. So by now you should have realized that you need to calculate the present value, because the 850 is not the present value, it's a future value. So your future value, and here you will need your calculator. Your future value is 850,000, but they say, or let's stick with the millions, 850 million, but at a discount of 2%. In other words, you would only be required to repay 89 or 98%. Everybody happy with that? Okay, then we need to calculate. Okay, so let's use the information that's given. The period is 8 years. The interest rate that we have to use is what?
Isn't it 12.5%?
9% after tax.
We said 9%?
9% after tax.
100%. It's 9% after tax. Okay. And then we need to calculate the payment. So the payment will be 850 times their percentage interest, but after tax. Okay, and that will equal, if my calculations are accurate, 91.8 million. So that's if you've rounded it a bit. So you have to now compute present value. So if we say the future value equals 850, and we say the PMT is the 850 times 0.15 times 0.72. The interest rate we said was 9%, and the period will be 8 years. We have to compute the present value. The rate is 9, number of periods is 8, the payment is that, and the future value will be the 833. So I get present value of 926,151,006. Everybody happy with that?
Yes.
Charles?
Lisa?
I'm just lost. Where did you get the 9% of the interest?
It is the 12.5% after tax, the 15% after tax.
But when I check the
12.5.
The 12.5. Sibanyoni?
When I check on the information, it is interest of 15% before tax.
But you have to use the market value.
Sorry.
So you have to use the market value before tax to get the interest rate.
Oh, okay.
You will say it's the 12, let's say it is the 0.125% times 0.72. And that's the 9%.
Oh, okay. All right.
Okay, so we have that value. That's the total value. Everybody happy with that? Now we need to say the portion of the capital structure. The percentage of capital structure, because we want to calculate the current capital structure. So that will be that value of ordinary shares in each of the other lines divided by the total.
Hello?
Hello?
Yes. Okay, I'm not getting the correct present value on the debentures. I'm not sure I'm getting 935 million.
Okay, I think I know what you did. Your present no, are you saying you're getting your present value that?
Yes.
935.
Yes, but my future value is 850. My payment per month is 92. And then the number of years is 8 years. And then the interest is 9%. I'm not sure.
You have a mistake there. Your future value must be that value, not 850.
Must be?
Can you see the screen?
Okay, must be 82. Okay, I got it. I see.
Because you are reducing, or you are paying back that 850, but at a premium of 98 of 2%.
Okay.
At a discount of 2%. Sorry. If you read the information, they say they're at a discount of 2%.
Okay. Thank you very much.
100%.
Mr. Charles?
Yes.
Will it be okay if I still keep my values lower than yours, not use millions and use the 850, the 9180 instead of 91,800 and what?
As long as you indicated then as million, but I would rather suggest in your final answer that you express it as the full figure.
Full figure. Okay.
Yes. Because that would be my recommendation. But you can still follow what you feel as accurate, but that will be my answer on that. Okay, so that's the percentage of capital structure that I get. And now we want to calculate the cost of capital. I'm going to give 2 minutes for the calculation of the cost of capital of ordinary shares, just ordinary shares.
Sorry, Charles.
Yes.
I'm just looking at the total for percentage of capital structure. It doesn't add up to 100. Would it be a problem if you don't do any adjustments during the exam to make it up to the total of 100%? It adds up to 0.99.
It's a difficult question that you're asking me. I'm going to tell you what I would have done. Since you are constrained in the exam for time, do not keep on recalculating and recalculating. If you see that you've made an error and there's no time to go back and fix it, the main suggestion and the main advice I can give you is to carry on using the percentage that you've calculated, because they will continue marking with your error. But if you then suddenly change your answer and they can't trace where you've gotten your percentage, then they will mark everything incorrect. So if you calculated 23% and you think it's incorrect, keep on using the 23%. So then they can follow where you applied that 23% or the 14%. But if it didn't add up today, then it's a problem, because then you need to identify why you couldn't get to 100 today, because that's the reason for this class.
All right.
So identify where you might struggle and where you might have misunderstood something or whatever the case may be.
All right.
Okay. So guys, next up is
sorry, Charles, I just
yes.
have a question.
Yes,
on the preference shares, you've got there 1.5 billion though. I'm not sure if it's just me, but I've got 1.5 million.
Let's quickly check the information. Yeah, it should be 1.5. It's 1,500 million. Because that's the value. So you still have to add 6 digits to that. Because it's rounded in millions. So you still need to add 3 zeros to that.
Yes. And then when I'm calculating the 1,250,000, and we multiply 12%, and then we divided it by 10%, and then I get 1.5 million.
Okay, so there's do the calculation on the screen. So it's 1,250,000 0.250 times 0.12. That answer divided by 0.1. So now I get 1.5, and then I still get 3 zeros next to it. 6 zeros next to it. So I'm happy with that answer.
Charles,
Yes, Lorraine.
just to help there, I think the mistake that most of us make, especially with this rounded off figures, is knowing how many zeros to add. So my advice would be, when you get an amount like 1,250, then don't count when you punch it on your calculator. Punch the whole amount, 1,250 plus the 6 zeros, so it makes it easier not to miss any zeros. So that's why maybe she's seeing it as 1.5 million.
100%. So, Lena, are you happy?
Yes.
Sorry, I'm not sure whether it's Eunice or Saralina. I only see the names on the screen.
That's okay.
Okay, so that's that value. So going back to the calculations and the information, so let's quickly calculate the value or the cost of capital. So cost of capital ordinary shares. So how will we go about calculating that? So we say the cost of equity equals my future dividend, D1, over my current share price plus the growth rate. Everybody happy? So the current or the D1 is 25 Rand over the share price. Sorry guys, I missed it here. Remember, it's to get to D1, you have to take the current one, that's the 25 Rand that they give there, because I say it's currently the 25 Rand payment, so you have to still add the growth rate to it. So you have to say times 1.07. The current share price is the 200. Remember to exclude the dividend. It's not the 225. It's the 200. So you have to take out the dividend. Plus the growth rate, 0.07. So that will equal, what is the 20? What do you get when you say 25 times 1.01?
26.75.
Okay, thank you, Ellen. I just want to also calculate it on my side so I can do the rounding. So 26.75 over 200 plus the growth of 0.07, and that answer equals.
Sorry, Charles.
Yes.
I just wanted to ask, how do you get the growth rate to 7%?
Let's quickly go to the answer. They say here, they say the number of issued shares has remained unchanged since the incorporation of the company. The first dividend that was declared on the 1st of July 20.4 and amounted to 12.50 per share. So that was the share price 10 years ago. Am I right in saying 10 years ago?
Mm-hmm.
So 12.50 currently it's 25 Rand less 12.50. What's that value?
It's 12.5.
Okay.
12.5.
Divided by 10.
1.25.
So that means it grows every year. So it was 12 Rand. It was 12 Rand 50 plus R1.25. So the next year it was R13.75. So what is 1.25 over 12.5?
It's 0.10.
Wait, I'm doing something wrong here. Let's take this away. Let's do it the financial calculator way. Apologies. The next step is going to be too long. What is your present value? What is your future value? PMT? 0.
0.
Number of years?
10.
10. Compute I.
Thank you, that makes sense.
Okay, everybody happy with that? What I calculated there when I got to the 10%, that is the cost of equity. That's just a short way to calculate the cost of equity. This is to calculate the growth. Okay. Your I will be, if I calculated correctly, 7.18%. So therefore you can say it equals 7%. Okay. So now let's calculate the cost of equity for ordinary shares, not like I did with preference shares. What would be the cost of equity? Everybody happy?
Yes.
Yes.
I'll include that in the calculation. Let's put that cost of 20%. Are there any questions? Guys, I see a lot of hands up. I just want to double check that I've not missed any questions. Okay, 100%. I will WhatsApp you guys the solution and the calculation that I've done.
As we give our numbers, or you're going to send it according to the student numbers?
Guys, I'll just post my number again. I did it in the beginning of the session. I gave the number. So just see in the chat section, there will, in the chat section, there will be a WhatsApp number. So I'm saying WhatsApp number. And please make sure that you send me your name and student number. The module code. Okay. Okay, 100%. You guys happy?
Happy.
Okay. Guys, I got the question in one of your previous question banks. I'm not sure whether it's in the latest question bank, but if you have it, don't remember the worst way that you can study for this exam is by looking at the answers. that is a recipe to fail. So that's why we're doing this participatory session. It's not for you to look at the answers, but to try it and fail rather in this session so that you can correct whatever you do not understand, then go home or back to your studying and then look at the answer. You will not pass that way, because then in an exam you will not be able to understand what they are asking because you don't have a solution to look at. Okay, so let's quickly calculate the preference shares, the cost of capital. Let's look at the information. We always go with the market value. They say the similar preference shares have a current market return of 10% per annum. So 10%. You don't have to deduct tax. And debentures. If you say, look at the debentures, we already calculated that part. Then they say the prime interest rate decreased since, and similar debentures are currently trading at 12% before tax. So we've already established that in the previous section to be 9%. When we did our calculation here, we said the interest is 9%. So what will be the weighted average cost of capital? It will be your cost times the weight. Everybody happy?
Yes.
Okay. And that was for 22 marks. Let's go back to the question. I just want to see what else I ask. Okay. Guys, I'm going to leave you with B and D to do on your own. You guys know now what question it is, so you can go and look at the solution. I just want to go through through C with you. Calculate the number of ordinary shares which must be issued in order to finance the expansion. Everybody happy? So let's look at C. Let's look at the information first. Ellen.
We are supposed to round off to full percentage there on A. Thank you.
Okay. Let's look at the information. So here they say, let's look at the expansion. Okay, so they want to expand, and the expansion will amount to 540 million. The project will be financed in a ratio of 60% equity and 40% debt. And then they say 124 million of the retained earnings are available for funding of the expansion. Okay. So they want to know how many new ordinary shares will be issued. So let's look at the calculation. Part C. So firstly, they say we are looking at 540 million. Okay, so that part will be funded. %60 equity and 40% debt. So 60% equity amounts to how much?
$324 million.
100%, 324 million. But then they said 124 million of the retained earnings will be of the million of the retained earnings are available for funding of the expansion. Okay, so let's first Sibanyoni.
No. I wanted to ask because I don't get the same figure to say. Don't we consider the 125 million, but you're still going there? It's fine. Thank you.
Okay, 100%. So we've split it, and then we said, but the 324, we can reduce that with the 124 retained earnings. So then we get 200 million that still needs to be funded. And the current share price is 200 Rand a share. So the number of shares equals 1 million shares. Everybody happy?
Happy.
I'll include that in my solution. So that is part C. Okay, 100%. Everybody happy?
Yes.
Okay, I'm just gonna stop sharing the screen and put up the next question. I'll share it over WhatsApp as well. I'll first add everybody that has sent me a request to join the WhatsApp group. I'll first add everybody, then I will do, I'll share the solution as well as the, I'll share the solution, the notes that we've made today. Okay. Sharing the last question. It's an earnings per share question. Guys, can I please, I need to ask you guys a favor. In this chat section, there is a session evaluation form. Since this is the final class, I would really appreciate your final feedback. So before I start, I'm going to give you, say, 5 minutes. Before I start with the new session, if you can please complete that session. Please complete that form. Apologies for that misannouncement.
Sorry, Charles. Where's the form?
I'm going to try and post it to you now.
Thank you.
Okay.
Guys, you can just keep a look on the chat section. Adele Blacker is posting the session evaluation form right now. If you guys can please complete that evaluation form for me, I'll give you 5 minutes, and then it's not even going to take you that long. It's very, very quick, and then I'll continue with the earnings per share question. If I can just ask by way of indicating with the hand function, if you can just lift your hand or show the hand function when you are done with the form, I will appreciate that, and I'll continue with the earnings per share question.
When we are done with the form, do we send it back here? Charles?
No, it's an online submission. It goes to UNISA directly.
Okay.
So it is an anonymous evaluation form, so you can just complete it and it will go directly to UNISA.
Okay, thanks.
It's giving an error, Charles. It's saying you don't have permission to view this form.
Okay, if it's giving you guys that error, then please just post. You're welcome to post your feedback in the chat section once the session is completed. Adele, I'm not sure whether you can hear me. I'm not sure what to do with that specific problem,
Charles,
but yes, Adele.
I've just tested the link in the chat. It's working.